Hey everybody, Chuck Barone here. Tuesday, January the 24th, 2023. And we figured you guys were getting a little bit tired of the white, just simple white backdrop behind me. So we went and bought this fabulous New York City backdrop so you guys could have something much better to look at than my mug, that's for sure. But anyway, start of some of the stuff we promised you guys we're going to try to do to make the show a little bit better. This is what you call a baby step. Anyway, as always, the first thing, we want to welcome you guys to the show. Thank you for your support. What you guys do every day for this show, watching the videos, commenting, and everything else to keep us going. We appreciate you guys. Markets today. Well, kind of a not much happening day today. Stock market ending up mixed today on earnings. Microsoft earnings up. Decent earnings for Microsoft today, but everything else coming out kind of not so great. Union Pacific down, 3M, which is a big company, also down. Texas Instruments, first loss since 2020. So the market's just kind of not a lot of data today. Everybody's waiting for later in the week. GDP numbers, unemployment numbers, consumer spending. That's what everybody's waiting for. So today just kind of a take a breather day. And we'll see where it goes with new data tomorrow. Bond market today, yields sink a little bit. The 10-year, amazing, 3.47%, down 6 basis points. The 2-year, we still got the big inversion. So the 2-year at 4.21%, down 3 basis points. The inversion is what now? 74 basis points. It's big. They tell us that the gap, the inversion, the size of the inversion is a little bit of an indicator of the size of the recession that's typically going to follow that inversion. If that's the case, the recession we got coming up is not going to be a nice one. The funny thing is, though, again, these things tell us that this recession is either here or coming. At the same time, it seems like a lot of the economy is still just galloping along. I guess you're having some issues, of course, in real estate and some other interest rate sensitive industries. Consumers kind of spending less now. And it's certainly, if they're spending less, getting much less, because you have to spend more to get the same amount now with this inflation. So it's just been such a crappy, weird, mixed market right now. Data just very difficult to get an idea of where things are going when you're getting data like we've been getting over the past course, even really the past year. The dollar today down small, but an important thing, breaking support at 102. Now it's 101.95. Dollar kind of just on a downward trend here, was up at 109.1 point. At 109 at one point. So the dollar's come down a ways, and it looks like it still has a ways to go. We'll see. I don't know if the Fed really has much of a care right now about defending the value of the dollar. They kind of have this corporate bullshit in their brain that a weak dollar is somehow better for us. So we'll see if they're going to do anything to defend this dollar as it kind of keeps edging its way down. Metals today had a nice little up day. Gold rallying $6.20, $1,936.80 per ounce. Silver rallying 22 cents, $23.65 an ounce. I think metals want to rally. I've been talking about it on the show for a while now. I think that we still got a little ways to go in this rally. I think we're going to see gold 2,000. We're going to see silver $25 coming very soon. I really believe that's going to happen. Oil today down, $1.50 per barrel for West Texas Intermediate, settling at $80.12. Interestingly, I've stopped reporting on natural gas because it was just been the stupidest, most ridiculous market, gyrating all over the place, where it's impossible to trade or even pay attention to without gasping. Today I just took a peek and I saw natural gas prices are in the 3s for their million BTUs. That price for natural gas is cheaper than the price of natural gas before the Russian and Ukraine war. So I guess what? They're having a warm winter. The demand for gas isn't what they thought it was. They're getting gas from other suppliers. Natural gas was over $9 for this contract, million BTUs. Now in the threes. Let's see how low it can go. Bitcoin today, up small, $47.50, but an important number, breaking 23,000. So there's your resistance, broken through. Now that becomes a support number. Let's see how far this rally in Bitcoin has, man. I got to admit, I'm eating a little bit of crow here because I really thought Bitcoin and cryptos were in some deep, deep doo-doo. Still kind of do, but this rally from 16,000 and change to 20, almost $7,000 rally, up almost 50%. That's just an incredible surge. Go Bitcoin. Today in real estate, we had a little bit of interesting stuff. Big, of course, like always, mixed signals in real estate, like everything else these days. So we saw D.R. Horton came out today with their earnings. They're one of the biggest builders here in the U.S., and they actually did good. Their earnings beat estimates. Their prices are, their prices holding up. So the higher prices making up for the lack of the smaller amount of actual sales, unit sales made. They're measuring by dollar volumes. So D.R. Horton beats earnings, but the issue with real estate, still prices declining, trickling down, trickling down, trickling down. We're down almost $70,000 here in Las Vegas from our peak. Buyers just now starting to kick the tires on real estate. Hopefully here in Vegas and around the country we'll have a little bit of our spring real estate rush, which we get every year. Rates coming down from over 7 to around 6 3/8 today. So with prices coming down and yields coming down, buyers starting to stir, still the payments are still brutal, but nonetheless, starting to kick tires, starting to get an idea of what they got to do. I think that with a little bit of luck, prices continuing to decline, if more longer-term rates could continue to drift down, we might get back into a market that can function in real estate in this country, which would be kind of nice. Interestingly, though, we've talked on the show before about these big real estate investment trusts, Blackstone, Starwood, KKR, Carlyle, all the big fees, the big venture capital guys, the big private equity hedge fund guys, all into real estate now. Well, they're having some problems because they're getting hammered with people who want their money out of these funds. Blackstone having some real issues. They're the biggest. They have a fund that's $69 billion. If I'm an investor in that fund, I think that in my mind, I'm going to hang in there and stay in that fund because the worst is kind of over for Blackstone on that deal now. But people still trying to take their money out. Blackstone actually selling assets. They sold out their interest in the Mandalay Bay. They actually owned 51% of the real estate under the Mandalay Bay, the buildings and everything in them. They sold that out to Vici. Now I'm reading they're selling out one of the biggest real estate investment trusts in India. They have a pretty nice hefty part of that fund, valued at $480 million. That's going to be sold out now, it looks like, to Bain Capital. They're in talks for Bain to acquire Blackstone's stake in that real estate trust. So Blackstone selling stuff to meet these redemptions. Now listen to this number, guys. They said that in 2022, Blackstone, KKR, Starwood, these big trusts, had redemptions of $12.2 billion people pulled out of these funds last year. Now here's the thing. That's a big number. But when you look at the size of these funds, is it really that big? Well, to give you an idea of how much of a difference the redemptions were in 22. In 2021, only $1.5 billion in redemptions. So they got an 8-fold increase there. So real estate, investors still skeptical. I think a lot of people have gains in these big trusts, so they're trying to get some of their profits out. So what's going to be interesting to watch it. But again, just adding further adding to the confusion and what's up, what's down. Everything's flipping all around, all over the place. Nobody can get their friggin' bearings straight here. But there you have the state of real estate. We have Janet Yellen out there today. Man, this guy, can't we find a better spokesperson for the U.S. Treasury than Janet Yellen, guys? I mean, she's over there in Africa now, making just, making waves, right? Making waves. Now angering China. China's actually in Africa investing billions and billions of dollars. We're over there just talking smack like we do. China actually coming back and said, maybe you could talk some smack if you can get your own house in order, making fun of our debt, making fun of the size of our debt, the size of our borrowing, not to mention this ridiculous, stupid political nonsense with this debt ceiling standoff, right? So, I would just wish that the Fed and the Treasury would just retire all these schmucks, really. Do we need Janet Yellen out there talking? Do we need, all these Fed presidents, Neil Cash and Carey or Mary Daly or Bullard or any of these other guys out? Do we really need to hear from them, really? I liked it so much better when banking was done quietly, and the Fed didn't telegraph every single move they made. I mean, it made markets a little more exciting and unpredictable, but nonetheless, we have to listen to these yo-yos all the time, man. And I gotta say, none of them come out and give us anything that's useful. They don't give us anything that can help us in our day-to-day lives, can help us get more wealth. The examples they set with their craziness and their stupidity is not a great example to set for the people watching them. So on and on it goes with the government, man. I've been talking about this inflation and how there's two parts to it, right? There's monetary policy, interest rates, money supply, strength of the dollar. That's the dominion of the Federal Reserve. That's where they live. Then you have fiscal policy, budgets, deficits, borrowing, that kind of stuff. That is where the government lives, right? That's the Congress, Senate, House, Biden. Well, ideally, if you're trying to bring inflation down from 9.1%, and you're serious about it, you have monetary and fiscal policy working in tandem, right? These guys are going to do what they have, tighten situation. These guys here, the money people, the Congress, are going to spend a little less money. Maybe, not actually reduce spending, but reduce the amount of increases. Let's bring these deficits down. Can we get under $1 trillion in a year in deficits again? I don't know, man. The debt's exploding. No one's taking anything seriously. The government argues about nonsense. And in the meantime, Rome is burning while the entire government and every component of it is fiddling away like Nero, man. Horrifying. Anyway, we had a quiet day today. I can rant about politics and the government every day of the year. We had a quiet day today, so here's what we could take a second now to think about some stuff. Where are we? What do we think is going to happen? Okay, so we know that the Fed believes that the inflation rate's too high, and they're going to continue to raise rates. At least another quarter we're going to get at the end of this month, beginning of February. Likely another quarter sometime before the end of the first quarter of the calendar year. And maybe another quarter down the road to get them up over their 5% target. We know these rate increases are coming. I'm not exactly sure how much of that is priced into the stock market right now because everybody wants to believe in this pivot. So we already know rates are going to continue to rise and likely stay elevated for at least this year, right? We know that unemployment, the numbers on unemployment are continuing to stay hot, hot, hot. And we know the Fed wants to slow those gains in employment and wages, right? History tells us, what do they say on Wall Street, right, guys? Don't fight the Fed. So we're not going to fight the Fed. So the Fed likely will slow these wage gains, likely slow down the pace of unemployment. We'll see higher numbers coming on claims ultimately. I don't know how quickly. So we know that's coming. We know the Federal Reserve, at least from every indication we've gotten, really still believes they can create this soft landing. Even though they need to kind of force a recession to slow that demand down, they're really believing they can pull this soft landing off. You got inflation rates coming down from a high of 9.1, right? Now down to, what was it, 6.2, somewhere in that ballpark, 6.1. So rates, the inflation rate coming down. And that's still not a great number, but nonetheless, you know, it wouldn't have been unreasonable to think we could still be at 7.5% or 8%, considering we were just at 9% a very short time ago, a few months ago over the summer. So we know the Fed has kind of, let's just give St. Jerome a little bit of credit here. Even though he's telegraphed every punch and told us exactly what he was going to do, he's done it, and it seems being the operative word here, to be working. Inflation numbers continue to come down. It seems like the economy, especially if you're not related to real estate, which a lot of businesses are, still kind of just trucking along, man. Not great, not hot, but not recession, that's for sure. You got the weirdest world where last year we have 2 consecutive quarters of negative GDP, followed by 2 decent quarters of GDP. How do you define that? Is that a recession? Is that we had a recession, but we're already out of it? Well, I don't know. Crazy world, guys, but we know what's coming. We know rates are going to continue to go up and stay up. We know the Fed wants to bring these employment numbers down. So until we actually see that happening, we know we can expect what we can expect from the Fed. We know that, so now we can act accordingly. So the things we've been telling you guys, defensive investments, look for dividends. Now even you can start looking, I've seen CD rates above 4%. So now if you're a safety person, don't want a lot of exposure to stocks, but looking for still a reasonable little yield, there you go. So things are changing. We're going to be there every day to bring you guys the changes, tell you guys what you need to know. We appreciate your support for my rant tomorrow. I was laughing at some of the comments, that I don't do a lot of swearing. I don't do a lot of screaming and yelling and calling people names. Some of the comments made me laugh, though, talking about some of Greg's rants or our friend Gerald Salente's rants. I love both of those guys, and I think their shows are great. And they sure are different than I am. My rants are a little calmer. I think might be a little more biting, but not as funny. Anyway, that's it for today, guys. We really appreciate your support. We're going to continue to try to do some of the upgrades. Look for some changes on our webpage. That's coming very soon. I'm going to show you guys how to beat the stock market this year. I'm going to actually document it going back to January 1st. That should be up anytime now. I'm just getting all of that together, how to present it correctly for you guys on the web there, or on the website, and other stuff coming. So anyway, we appreciate your support. We'll be back again tomorrow to wrap things up. Hopefully we'll get a little more data, have a little more something to talk about in this market. Until then, guys, take care. Thanks.